Today I'm joined by Anthony Ginsberg, founder and CEO of GinsGlobal Index Funds. Welcome, Anthony. How are things?
Great to be with you, Hayden, from California.
Yeah, great. Based here in London, so a bit of a time difference, but we really value you waking up early and taking the time. Let's start with your background. I want to introduce you to the listeners before we get onto the kind of key subject matter here today. So firstly, what led you to found Gins Global Index Funds? I wonder whether there was a eureka moment, perhaps.
Well, there certainly was. I'm actually a product of Cape Town, South Africa, but I've been living in the US almost 30 years. I actually moved to the US to work on Wall Street at Solomon Brothers, which today is part of Citibank. Some people know the book Liar's Poker, that was all about Solomon. And then subsequently worked at Barclays. So having worked at two large Wall Street institutions, the eureka moment, Hayden, was that very few of these Wall Street firms were beating the benchmarks or outperforming the indexes. They had lots of smart people running around doing lots of crazy things, but it was very rare to find the diamond in the rough that would actually outperform the index. And while I was in the US in the 90s, firms like Vanguard and others were essentially conducting a revolution here. More and more pension money and mutual fund money was going in to index funds and ETFs as well. So for us, index funds and ETFs are sort of one of the same thing. And increasingly today, we see about 50% of all mutual fund monies basically invested along index lines, whether it's ETFs or mutual funds. And today, of the five largest investment firms in the US in particular, and now globally, three of them are actually indexing firms. We work very closely with State Street, which is actually one of the three. The other would be BlackRock and Vanguard.
Yeah, fantastic. And I wonder whether that background kind of conversely, I suppose, prepared you in any way for the Gins Global Challenge.
Yes, well, one of the issues is coming from a developing country, you recognize that it's very intimidating to know how to invest your own money or your family's money. And you see hundreds and hundreds of different asset managers out there. Ultimately, all the latest statistics over the last 15, 20 years shows us trying to find a needle in a haystack, identifying the few consistent fund managers that typically outperform well-known indexes, whether it's the S&P 500, the FTSE, the Euro stocks. So identifying that needle in a haystack is quite risky, actually. It's less than 15% over a 5-year period. As you go out 10 years, you see a lot of the worst funds actually closing or merging out of existence. So when you look at the data, often only the better mutual funds that are run by fund managers remain. So the statistics can be a bit distorted, but the latest S&P and other data show almost 90% of fund managers over a sustained period, 5 to 10 years, underperformed these well-known benchmarks. And I was really trying to help investors, whether it was from my native South Africa or from the Middle East or other offshore markets, to figure out, well, why does the US have such a preponderance of indexing back in the day in the 90s, when at that time in Europe and elsewhere, very few investors had the choice. Frankly, the eureka moment probably was at Barclays. They wouldn't permit me to sell some of their iShare products, and which were ETF index products at the time, to British and European investors. And I got somewhat frustrated with that, because I could see that indexing was a really good way to build a core global portfolio at low cost.
Yeah, absolutely. And that's one of the key benefits of the products we're here to discuss today. And that's the Gins Tech Megatrend Equal Weight UCITS ETF. So I did a bit of research before the call to understand how you were selecting instruments and equities within that fund. And I believe the fund tracks the Selective Innovative Technologies Index. So perhaps you can just start by talking to us about the composition of that index and what it aims to offer exposure to.
Yes, Hayden, what we've done is we looked at the digital revolution and essentially divided it up into 8 sub-themes. So the Tech Megatrend ETF actually is equally weighted, meaning it's lower risk across 120 global holdings. So unlike something like the NASDAQ, which is 100% essentially US stocks, the Tech Megatrend actually includes about 9% Japanese stocks right now. China is just over almost 16% due to the recent rebound. It's actually helped us. There are UK holdings in there, but of the 120 holdings, they're divided up equally across 8 key sub-themes, which I'll just run through: cloud computing, cybersecurity, online streaming or digital entertainment. We've got AI, robotics in there. We've got gene sequencing as well. Electric vehicles are in there too. So it's been social media would be another one that I should mention has been a big contributor of late. So the final one would be blockchain. So there are 8 of these equally weighted sub themes. We're not trying to take a bet, Hayden, on one versus the other. It's really very difficult to time these things. Some are actually overlapping with each other. Things like cloud computing, which has grown tremendously due to COVID and work from home phenomenon. You now see cybersecurity companies being acquired by cloud companies. So those are almost like becoming first cousins, and perhaps will be closer to brothers soon. But the whole digital revolution is actually being underpinned partly by cloud. But then you see things such as online gaming, which is part of our digital entertainment sub-theme. And a lot of that is utilizing mobile technology and 5G as well. So up to half of gamers today are basically using their phones for the games and also using cloud computing. So a lot of these things are overlapping and interacting with each other. So we actually talk about the convergence of the mega trend. And for us, it's a global story rather than just an American story.
Yeah, absolutely. And I want to get onto the outlook for some of those individual sub-themes shortly. But before we do, fundamental to the ongoing management of the product is this equal weighted nature of the competition, which you've already discussed or touched on briefly. But I want to dig into that. So rather than
Yes.
market cap weighting the products like a lot of ETFs in this space do, why did you take that decision to equal weight?
Well, that's a very fair question. So when we looked at some of the competitors, particularly something like the QQQ, which is an ETF tracking the NASDAQ, you recognize that about 8 stocks represent about 40% of the NASDAQ. In fact, 55% of the NASDAQ today is comprised of 10 stocks, primarily the FANGs. So it's very, very narrowly concentrated. And obviously clients want to play the FANGs, but they want broader exposure. We see Tech Megatrend really as a complementary product, given its global nature, and also given the fact that we're diving a bit deeper than the NASDAQ. So our top 10 is only about a 12% weighting compared to the NASDAQ at about 55, 56%. And the top 5, again, is also very, very small. We're at about a 7.5% weighting versus a NASDAQ at over 30%. So what we try to do is to dig down into companies that may not get much lift or recognition in a NASDAQ index. For example, cybersecurity companies, robotics companies, many of them are not in the FANG mega cap market cap level. So a lot of what we have in Tech Megatrend would be classified as large cap or even mid cap and some mega cap, but our FANG exposure is somewhat underweight. So we're really appealing to a broader base where clients say, look, we may already have an over concentration in the FANGs. How about if we want to play the digital revolution in a broader sense with these other sub themes? But you make a good point that we are essentially not just equally weighted, we've also gone beyond the traditional tech world. If you look at the recent classification of technology by some of the stock markets, unfortunately, whether it's the S&P has a tech index, the LSE may have a tech index, they're increasingly very narrow. They kick out social media companies. Unfortunately, they've kicked out a number of other things, such as electric vehicles are not part of a traditional tech index. So what we've tried to do is to actually broaden it and say, look, but gene sequencing is using a lot of tech as well. So we probably have 3 or 4 of these sub-themes that, frankly, a traditional narrow tech index is primarily focused just on semiconductors, some hardware, and some software. We actually see the convergence of a lot of these underlying revolutionary, disruptive themes that really should be called, even fintech, for example, for us, rather than being financial, should also be considered part of a tech fund. So we've tried to go somewhat broader than the strict tech definition.
Yeah, absolutely. And so in doing that, I suppose you're helping people avoid overexposure to those mega cap shares like Microsoft, Apple, etc. Which is great, and that enables them to get, I suppose, diversification that they would otherwise struggle to get, which is important. But I just wonder whether you monitor or aim for an optimum split or exposure even to small, mid, and large cap companies.
Yeah. So what we actually do is we pick the top 15 leaders for each of the sub themes. So we're trying to take the risk out of selecting for clients. It really is rules based. So of course we call it the Tech Megatrend Index. And what we've really done is taken 15 leaders across 8 of these sub themes. That's how 15 times 8, of course, is 120. But those 15 leaders typically are by market cap. So we actually have the 15 largest or most successful, let's say, global robotics players and global cybersecurity players, global cloud players. So that's sort of how we've tried to reduce the risk for clients by saying these are very established players. These are not fly-by-night companies. Not as though we're buying very tiny small caps or micro caps even. These are really very established players. In fact, 99% of the holdings are all profitable, making EBITDA profits, and have been around for many, many years. So we think it's a very established set of companies. And the main thing is to actually broaden the exposure beyond those FANGs, as you mentioned, which typically are about 6 or 7 companies that often have a hugely disproportionate overweight concentration in other products that cover tech.
Yeah, absolutely. And before I kind of move on to dig into that strategy a little bit further, where's the fund available?
So the fund is available on the London Stock Exchange. It's been listed there for over 4 years. We're actually coming up for our 5th year anniversary. It's had a good run. We're also on the etc. DAX in Germany, the Euronext in Europe, part of the Borsa Italiana, and then lastly in Switzerland on the 6th. So we're on 4 different exchanges at the moment. We're also registered and approved in places like Spain and the Benelux countries.
Great. All right, well, let's move on to the strategy then. We've touched on a few key points already, but I was reading the fund literature beforehand, and it described the company as trying to track, the fund's trying to track companies poised to benefit from the 4th industrial revolution. So that's I think, a term or a megatrend even that encaptures all of the 4 megatrends or the 8 megatrends, that you have within the fund. So that's quite a nice catch-all, but a fairly abstract concept potentially. So I was interested to understand your definition of Industry 4.0.
Yes, of course there are broad megatrends that some people say may relate to things like water or climate change too. We're specifically focused on the digital revolution, where tech and the whole 4th industrial revolution intersect. So that's probably why you'll see in our sub-themes that they're all somewhat related to tech, whether it's social media, electric vehicles, or even blockchain. We're not betting on the direction of crypto, incidentally. The blockchain one is very broadly based to do with things like fintech and the digital ledgers online that help streamline transactions. The other ones, if you look at things like cloud or gene editing, they're all essentially fast-tracked due to some form of technology. That's really what's underpinning all of this. And of course, AI robotics has been one of the hottest of late, and happy to talk more about that too. So we've tried really, really hard, Hayden, to focus in on where the tech revolution is actually driving productivity across media, across manufacturing, obviously entertainment as well, and motor vehicles in particular. I think many believe that what Tesla has produced is frankly more a robot on wheels than a traditional motor car. So you're happy to dig into that a bit further, but really we're focusing on the technological change that is underpinning the way we work, live, and play. So the way people are playing today, increasingly, whether they're using a Kindle or they're on Netflix or Amazon Prime or Disney Plus, they're going work from home, meaning that basically cloud and cybersecurity have seen huge gains because of remote working. So yeah, it's really about the differences in how we are all going about our lives in the early 21st century.
Yeah, absolutely. And there's some really obviously exciting sub-themes in there. But how did you land on that final list of 8? I imagine that there are a lot of ideas that you would have had to filter down before you landed on your final 8 sub-themes.
Yeah. Yes, I have to give credit to the fact that we're working with a well-respected thematic expert in the third party of Selective. So Selective are a leading index player actually out of Europe. We actually looked at using people like S&P and MSCI, and we actually ultimately landed on Selective because they've got significant AI technology. They actually utilize not just their own algorithms, but they've been offering thematic products for many, many years. They also offered us the potential to have an Article 8 product, meaning that we would be ESG compliant across all the bourses. Obviously, in parts of Northern Europe in particular, and the Nordic countries, being ESG compliant is increasingly important, that it's going global. So we're very happy that we do have this essentially very highly rated ESG compliance as part of the product. But really, Selective assisted us in saying, at the end of the day, these 8 sub-themes really do capture the fourth industrial revolution in terms of technological innovation and the major tech trends that we see playing out for at least a decade or longer. These are not fads. Like, the key thing is we've tried to stay away from something that may be faddish and may not be around in 5 or 10 years. We also wanted to have at least 15 leading investable companies. And the way it works with ETFs is you need a minimum market cap. Typically, they've got to be liquid enough. So typically, the minimum cutoff for us is something like $500 million of market cap minimum size as an investable product or underlying holding. So it has to be at least 500 million in market cap. It's got to be somewhat established. It also should have enough turnover or trading liquidity per day, which is typically $2 million plus, so that it can be included in the ETF. And by European standards, we also wanted to qualify for the UCITS qualification, which means that you can't actually have 10% in one company necessarily, or half your ETF dominated by 3 or 4 or 5 players. So we've tried really hard to comply with European standards. And that's really why you see the diversification. Most of our clients, frankly, are looking over a period of 3 to 5 years to try and participate in the megatrend. So they're not really traders per se. They're looking at upside as a long-term trend. And over the last 4.5, 5 years, we have provided good gains of almost 40-odd%. I mean, obviously we can get a bit further into the returns, but year to date we're up 24.5% just in 2023 as well.
Yeah, I want to dig into performance because it has been particularly good. But before we do, you mentioned time horizon there. People kind of not trading this product. They're not, speculating on price action or anything here. They're looking to participate in multi-year trends. So would you say that as kind of a broad minimum, people need to be invested in a fund like this for at least 3 to 5 years?
Yes, I would say so. If you actually look at our returns, which we'll get to in a moment, typically there is some volatility. One has to be frank about it in the megatrend and tech space. Of course, there was terminology such as the metaverse. People will ask, do we include that? Well, we do include it via the likes of Meta, Facebook, and others. We don't actually create a Meta sub-theme because at the moment we don't see it being profitable for the next many years, although online gaming is obviously part of our theme. So the simple answer is we are looking out to a period of at least, I'd say, 3 to 5 years for people to participate in the upside. Interestingly, by equal weighting across 120 holdings, you also get a bit more diversification and comfort in terms of reducing your risk. Because if you look at the other tech products, as I referred to earlier, they typically are extremely overweight in 7 to 10 FANG type stocks, whether it's the Netflixes or the Amazons or the Apples of this world. And often we found clients already have those holdings, perhaps in an S&P 500 or an MSCI World Index. So we try to create a complementary index which said, hang on, yes, we'll have the Amazons and the Teslas and the Netflix, but they're going to be equally weighted across, regardless of market cap. And we wanted to basically provide more exposure and bring to life leading cybersecurity players, robotics players, gene editing players that typically get subsumed, frankly, in a traditional tech fund, particularly these tech indexes that are heavily overweighted by just a handful of holdings.
Yeah, absolutely. And we're kind of touching on the subject I want to move on to now, which is that comparison with broader tech funds. And with that in mind, how should investors look to benchmark this fund's performance? Do you compare it against the NASDAQ 100, for example, or is there a more specific benchmark you use?
Yeah. Well, Selective, who are helping us create the benchmark and the rules for this, where you've got 120 holdings, that actually is the benchmark. It's called the Selective Tech Megatrend benchmark, and it's produced on all our fact sheets. So it is like apples and oranges if we compare ourselves to the NASDAQ, because when FANGs run that they may look a little bit better, but we've had a pretty good run against the NASDAQ the last sort of 18 months. The interesting part is that we see ourselves actually as providing a complement. Again, we don't see ourselves as necessarily competing with the Nasdaq. We have friends who've obviously already got access to that, but more and more of our larger clients, including even pension funds and institutional folks, will say to us, we already have massive access to the FANG type stocks that dominate Nasdaq. Can you provide us a broader picture? And actually, the Megatrend grew out of a California product that we were offering to insurance companies here in the States who wanted broader exposure for technology and really participate in the fourth industrial revolution. They call it here the digital revolution. And we're getting a bit frustrated that basically all their exposure was more largely to a handful of players, where in 2022 you saw obviously significant volatility with the likes of NVIDIA falling significantly last year, although it's had a huge rebound now. So we're really appealing to clients who wanted to broaden their tech exposure and holdings. And actually the geographical spread is quite important. We only have 58% American exposure at the moment. China's, I mentioned earlier on, is approaching 16.5%. You've got Japan in there. You've also got the UK, a little bit of Canada or Australia. So what's unusual, I guess, for us is that we actually have a global benchmark. Many of the other tech products we see are very much US centric. Often they'll only include holdings that are listed on an American stock exchange. So that they didn't benefit recently from the China reopening. I mean, we own Alibaba, we own Baidu from China, a bunch of other, I mean, obviously there's some leading social media players there. And in Japan, there are leading robotics firms as well, and some well-known digital entertainment or video gamers. So we own those too. So we've tried to really look at it more globally.
Yeah, absolutely. No, that makes a lot of sense. And I'm keen to understand then the ongoing management of this product. How often is the fund rebalanced, and kind of what thought was put into the rebalancing of the product? Because the reason I ask really is because I imagine certain sub themes, when they're outperforming, you almost want to give them the room to shine and kind of have a little bit more share within the fund's composition. But how does that work?
Yes. In fact, that's the reason why we rebalance only twice a year. The challenge of rebalancing too often is that you don't let those outperformers have a real run, because if you're rebalancing, some people we've heard will rebalance monthly or quarterly. Firstly, it creates extra costs every time you have to rebalance and reset it back to an equal weighted setup. So that was one of the factors. But the other factor is, I mean, we've obviously seen things like blockchain again this year take off. I mean, a few other ones like social media that has done very, very well, electric vehicles. If you rebalance too frequently, you basically, as you mentioned earlier, it's very prescient of what you were saying and perceptive, you actually lose that upside. What we've tried to do is be able to let it run for 6 months, take the profits, and then reset. So the taking of profits every 6 months actually also helps reduce the volatility and the risk in the product.
Got it. Okay, great. So as expected, there is a bias towards the US market in terms of the overall exposure, but far diminished versus some of those US obviously based indexes, for example. But given the country's sort of tech dominance, that's, as I say, understandable. But give us a sense of how the fund is weighted across other geographies. Is it relatively diversified in that respect?
Yes, actually, I think it would surprise folks that if you add up Asia, you're now getting over 25% exposure, closer to almost 30% exposure to Asia. So the US, as I mentioned, is around 57, 58%. You've got almost 30% in Asia if you add in South Korea, the largest being China, which is just around 16%, and then Japan, just over 9.5%. South Korea is about 3%, a little bit of Australia in there. And I guess you could argue that Europe is a little bit smaller than one might suspect, because you've got SAP, which is a big German company. You have a little bit of UK, but really, yes, I would say Asia is the second largest component after the US. The US has hovered typically between about 55 to 60% of the fund. We've never, and we've been very happy to ensure that the US, it wasn't essentially by design. The idea was to have a global benchmark. If they were the leading players were all from one region, that would be terrific. But in the real world, we knew this was never going to be the case. And that's why we look at askance at some of the tech funds today that are only using US listings that I referred to earlier, or you've got to have some sort of a US domicile to be part of the holdings. We thought that was a bit short-sighted, and our clients, frankly, Hayden, are mostly global anyway.
Yeah.
So they all pretty much wanted a global, benchmark. So yeah, the largest holding remains the US, but I have to say the reopening in China and also the recent Japanese revaluation of their stock market has actually provided us with a nice bounce. That's part of what you see with the almost 25% gain year to date.
Yeah, fantastic. And I wanted to reference a couple of those lesser known holdings. So Alphabet and Meta are probably probably the only two, when I was looking at the holdings yesterday, kind of recognized large established technology players in the fund's top 10. And just to give people a sense of the percentage they command within the portfolio, it's 1.06 and 1.04 when I checked yesterday. Might have shifted a little bit since then, but broadly speaking, relatively small. Perhaps you can briefly talk us through some of the other top holdings. I was unfamiliar with your second largest holding at 1.77%, Kunlun Tech. What do they do?
Yeah, well, I'm going to go through. Actually, I thought what I would just tell you is that you asked a question about the largest holdings and also the biggest contributors. And if you look at our top performers, which I thought I'd just go through, yes, we do obviously have for social media something like Alphabet in there. But I mean, our biggest contributor, for example, for cloud computing is a well-known name. It would be Salesforce. So that's been our best player in cloud. It was up almost 50% year to date. NVIDIA, which everybody's talking about at the moment, is actually our top robotics and automation player. So that is a reasonably well-known play. That's actually up over 100% year to date. Meta being our largest social media or biggest names, up about 90% year to date. And then Riot Blockchain, we've got a couple of blockchain players that have had a good run. Marathon, Riot Blockchain would be one that some folks will have heard of. Those things are up about 200%. Of course, they had a tough year, but they've come back pretty strong. Apple has had a good run, and we classify that as a cloud computing player in iTech. That's up about 31% year to date. And then just something that may not be as well known in gene editing, there are some Asian players in there. There's something called Jiangsu Medicine, which is up 27%, lesser known. Tesla would be one of our leading future car for that EV future car theme. That's up in the mid 30% range. The one you mentioned is an Asian player, and it's actually a social media company, Kunsun Tech, and it's up about 95%. And I believe that's out of Japan. So it's interesting that when you look at the sub-themes that have contributed most, year to date, just to give you some numbers, blockchain as a sub-theme is up over 100%. It's contributed over a third of our performance. So as a sub-theme on its own, it's up over 100%. Social media would be second best, up around 20% year to date. And then just to give you a quick sense of robotics would also be up about 19.5% year to date. So we've had quite a diverse bunch of gains. Something else that I thought I would just mention that may surprise folks is electric vehicles year to date up around 13%. And just lastly, digital entertainment, which is really the online gaming, online media, which we really see a big revolution, which I can touch on in the US, where people are moving away from TV. Obviously, many of your listeners probably use the likes of YouTube for their news, and whether they're using Netflix or online gaming. We've seen a massive growth of about 25% over the past year in digital streaming. This is in the US, and a loss of 10% year on year on TV viewership in America. Part of it is that cable TV is quite expensive. If you want to access something like CNN or some of the sports, you've got to pay a whole bunch of extra money. So it's actually cheaper to frankly buy 4 or 5 online streaming contracts, and you actually save a bundle. So many younger folks, but even my friends that I'm in touch with are cutting the cable, we call it here, and moving away from traditional TV. So that's up. Digital entertainment, just to summarize, as a separate sub-theme, is up about 18.5%. And we expect it to go even further when you consider Activision now, most likely, despite the UK blocking the deal with Microsoft, that online gaming deal has been approved by the EU. So Microsoft seems to be powering ahead to take out Activision for $75 billion, which is a large premium on top of their share price.
Yeah, fantastic. No, that's a great summary. I was going to ask you about the sub themes that have contributed to the good performance so far this year, but I think we've covered that off. You've also highlighted some top performers within each sub theme, which is fantastic. But the fund's up nearly, I think it's over 51%, having checked before the call since inception back in 2018. So people that have been invested in this fund a little while, or people looking to get into it after this podcast session potentially. What are we likely to see the highs that I believe the fund hit in Feb 2021 anytime soon? What's your kind of medium term outlook in terms of performance?
Yeah, we actually think the fund is very well positioned for a broad market rally over the next 12 to 18 months in the US. Typically, ahead of a US election, presidential election, you do see markets doing reasonably well. The Fed normally is in an easing mode where they're not raising interest rates. We actually expect the Fed to be very conducive for tech stocks and growth stocks, which many of ours qualify for. By the end of this year into early January or February, we do see the tech guys benefiting from a reduction in Federal Reserve interest rates. So there's going to be, we expect at least possibly one or two cuts early in 2024. And the Fed has actually also announced that they're on hold or on pause, which has already boosted the market. But what you've seen is a very narrow gain in the market. So a lot of our gain at the moment, as I mentioned earlier, has been blockchain, somewhat on the robotics side and a bit on social media and a little bit on the EV car side. But it hasn't been a broad-based market rally. Many of our holdings, you could argue, they're second-tier tech firms, or they're large caps, but they may not be the big name, FANGs. So we actually think we're well positioned for a rebound in the broader growth and tech market space as 2023 plays out, particularly with US inflation numbers now down to around the mid 4% level. I think we're half of the UK, give or take. And it's quite positive typically when you see rates going down that growth and tech stocks as a group should actually benefit. So at the moment, the rally's been quite narrow. We're actually hoping that of our 120 holdings, if you take out the well-known FANGs and maybe NVIDIA, there are 110 other players there that haven't really had a strong run necessarily. So even our own gains are generated by sort of small subset. We're expecting a broader market rally ahead and probably over the next 6 to 12 months. Hard to time these things, but we remain quite upbeat. Interestingly, a weaker US dollar will also help those holdings that are close to 60% in terms of the US weighting, so that their export earnings will generate higher revenues and slightly higher profits. So we're not too worried about a slightly weaker dollar either.
Yeah, fantastic. Well, I wanted to get on to tailwinds, and we mentioned two there. So lower US inflation in the second half of this year. We've got a weaker dollar as well, potentially. Another one that strikes me, and I think I read about it on your website, was this idea of convergence amongst the 8 sub-themes in your fund. It's likely it's at those intersections between each of those sub-themes where the real sort of exponential growth is likely to occur. But perhaps you can highlight a few instances of crossover between your chosen sub-themes to make it a little less abstract.
Yeah, absolutely. It's a great point. I mean, at the moment, smartphones are fast approaching about a 50% share of all gaming usage, but probably the most exciting one. And we'll get back to gaming and smartphones, because that's really underpinning that Activision deal that Microsoft's pushing so hard. They see second and third world countries, places where I grew up, like in South Africa or Latin America as well, where the cost of consoles are just beyond many folks who are not in the first world. So that's really underpinning where social media and online gaming are overlapping. I mean, I guess you see that already with certain streaming devices too. But what really is exciting is that how cloud technology is underpinning things such as video streaming, online gaming, 5G, cybersecurity. Without cloud being the plumbing behind it, a lot of what we're talking about, whether it's the work from home trends, yes, perhaps it could have still worked in the UK and Germany and perhaps the US and Japan. But when you get to the rest of the world, I just came back from Africa, for example, and there's still many of those office buildings are quite empty. People are still only working in a hybrid style 2 or 3 days a week. Interestingly, you see a lot more electric vehicle charging stations in parts of Europe or even in the US. We haven't touched on too much, but this green revolution is also something that we do buy into. That's partly why we're ESG. And that convergence where you see lower cost energy utilizing battery charging stations. In my own office in LA, California, we only had about 3 charging stations under President Trump. In the last 2 years under Biden, my own building has gone up to 28 to 30 charging stations today. It's a 10-story building. And you can now drive whether it's your electric vehicles from LA to San Francisco without any problem. Historically, there were charging infrastructure problems across the US. The US, as you know, is finally trying to catch up. So we've seen a doubling of the market share of electric vehicle usage in the States from about 5%. It's going to approach 10% very shortly. And the White House here has been really energetic in passing very tough emissions laws and rules, even in California. If you want to go on a highway here, post 2030, you have to have a hybrid or an EV vehicle. So it's coming thick and fast in terms of the green revolution we see in the US. I don't believe the tide will be turned back. So we're trying very hard to participate in all of these areas. We actually are very bullish on electric vehicle usage, and actually firms like Tesla, their biggest competitors at the moment may well be Chinese competitors. Obviously, you've seen in your neck of the woods the Nordics and Northern Europeans having a leading market share, because of their build out. So the infrastructure build out is finally happening. We have this thing called the IRA, or the Infrastructure Reduction Act. It's actually called the Inflation Reduction Act here, which is forcing more and more of the German automakers and other foreign car makers to produce and automate their cars and their battery plants in the US. And I noticed Jaguar Land Rover over there today probably have a big announcement about possibly producing batteries around Somerset in the UK. So we're very upbeat on. We have 15 leading electric vehicle players. They're not all car companies. Some of them are battery producers in our holdings. So it's may surprise people. It's not just the likes of Tesla. We've also got other well-known firms. You may have somebody like a Toyota or a Renault or a Volvo that are getting progressively more into offering 25, 30 different models of electric vehicles. So we're quite positive.
Yeah, absolutely. And in that EV space, it does seem there's plenty of headroom still available there. How far away are we kind of from saturation in that space?
It's very, very early days. So I get the same question, incidentally, about cloud. Just to tell you, cloud's only 25% of all corporate workloads are in the cloud.
Wow.
And then, so people say to me, Anthony, is it mature? It's certainly not mature. And even electric vehicles are even less mature. In the US, we have a 10% market share. Probably we're only going to hit that 10% number probably by the end of next year. At the moment, we're roughly about 7.5%, 8%. So it's very, very early days in terms of the build out of EVs. Can I just touch briefly on the fact that even cloud, which gets surprises people, that we're going to add $1 trillion of new revenue to cloud just over the next 4 years, means basically the cloud industry is going to be doubling in size. That's partly because the large Fortune 500 companies have been slow, frankly, historically, to adopt cloud. So we call smaller companies, such as ETF firms like herein, others, cloud natives, because mid and smaller enterprises have historically been using cloud now for years. It's been the big guys, the highly regulated industries, insurers, banks, healthcare companies, that have finally jumped on the bandwagon. That's why you see this additional $1 trillion of revenue. It's roughly equates to about a 20% year-on-year annualized growth over the next 4 years. That's really the likes of the Barclays, JP Morgan's, Pfizer's, large insurers like Zurich Life or AIG, really now using a split we call it a hybrid or a split cloud or multiple cloud, so they can actually separate much more easily since COVID. I have to say the cloud industry has made it easier for them to really spread their risks. In the old days, I'd say 4 or 5 years ago, the restriction with cloud was you had to bet on one particular provider, whether it was AWS from Amazon or Google, or maybe Azure from Microsoft. Today, many of these players will actually be able to use multiple clouds, and they can actually separate their European clouds for GDPR, privacy reasons, from their Brexit cloud, from their US cloud. So that's probably also why you see much larger adoption rates from these regulated industries. So we actually are probably in terms of growth levels, cloud probably should mirror electric vehicles in terms of 20% year-on-year growth globally.
Yeah, no, I'm really happy you did touch on cloud because I hadn't quite realized the overall potential in that space. And maybe one other theme that does seem to sort of transcend a lot of the sub themes that we've discussed already today is AI. It's obviously a pretty hot topic at the moment. And I was interested to get your thoughts on to what extent you think AI might actually bring us a new set of FANGs. And if so, which companies do you think might be part of that group? And will NVIDIA be one of them?
Yes, certainly NVIDIA has been able to segue dramatically. As you know, they were leaders in game chip manufacturing. Just with yesterday's recent announcement, actually, their data center business, which really is working with large cloud providers such as Amazon's AWS and Google Cloud, that data center is really driving their gains. It's all to do with using more advanced chips to allow AI to be integrated inside cloud computing and cloud technology. So most of NVIDIA's recent gain, just the overnight jump that we all read about, which is about a 30% gain, which is unheard of in a single day, is being powered by the fact that they are the leading provider of chips within data centers and cloud computing. So we certainly would say that they're one of the key proxies for AI, primarily on the hardware side. Now, when you look at software as a service companies, which will employ AI, many of them are cloud players. They're actually in our cloud theme. We actually happen to also have a cloud ETF. So we know a fair bit about software as a service. Something that's interesting with AI is we do see, people saying, well, can it be utilized in robotics? Can it be utilized in these other areas? There are firms such as electric vehicle players, robotics players that we invest in, who are all utilizing automation and algorithms and AI. So we see it as broader than just the hardware story. Yes, so it will converge across a number of these themes. Even cybersecurity and social media are employing AI. So for us, it's hard to just narrow it in on 2 or 3 companies. We actually see it across the likes of Facebook, Meta, of course, NVIDIA, but even Apple Computing, and some of the robotics players that we've got, and some of the other social media firms. And cybersecurity, there's a company called Palo Alto Networks up in Silicon Valley that's a leading player in cyber. They're all utilizing AI technology. Now, again, they may not be the biggest purchasers of the chips from NVIDIA, but they are utilizing it on a software level. So we do see it as a very, very large change. And it's going to boost productivity for office workers, in our opinion. I know my kids are teenagers, and some of them are ones at college where they're utilizing AI to try and help them on homework and whatnot. But actually, the utilization inside the office will probably be the biggest usage of Bard or ChatGPT. If I could just touch on one other aspect with automation, that also allows more manufacturing to come onshore at a cheaper rate, rather than having to hire expensive American or let's say British workers. Given the anti-China sentiment, and also just the difficulty of the supply chains that we saw during COVID, increasingly there's a move towards onshoring. And that actually plays into our robotics and automation / AI theme as well, because it means that these large manufacturers, by utilizing robotics and AI, they can actually bring back manufacturing to the first world, let's say. And it doesn't mean they're going to hire millions of new American workers necessarily, but somebody like Ford Motor Company or some of these other Silicon Valley chip makers like Intel are able to start producing at a lower rate, a lower cost on a far more automated basis onshore in the first world. So that's a key trend away from Chinese manufacturing that we also see. It's actually helped boost the robotics sub-theme. So I would say you got the China issue and the AI actually working in tandem to onshore a lot more manufacturing too.
Yeah, fantastic. And I try and end these interviews with a generic question, a similar question that I ask everyone that I speak to, and I think it's particularly pertinent within this conversation, which is simply, what is the next big idea? Perhaps there's a underrepresented theme or sub theme that we haven't discussed so much that isn't part of mainstream media conversation that you think more people should be talking about.
Yeah, I think because we all lived through COVID and just how quickly those vaccines were produced via RNA technology,
Mm,
uh, we've actually believe that gene sequencing is increasingly becoming more and more mainstream. That's why it's one of our 8 sub themes. Some people call it medical technology, but we actually see gene sequencing as very mainstream for tackling cancers and other
mm,
large, well-known diseases, dread diseases as they're known, rather than just going after, let's say, a particular vaccine. So there will probably be more M&A activity across big pharmaceuticals getting into genomics or gene sequencing, gene editing. So that's an area to really look at carefully. It's a much faster way to market, to bring a product to market, I should say. So the R&D, the whole process, which used to take a decade sometimes or longer,
mm,
to bring a new, you know, pill or medication to market. Today it's been fast tracked, and I think COVID has brought that out
mm.
in a big way. That within a year and a half, you can have vaccines. So we're very positive on gene sequencing being increasingly mainstream for medicine, rather than just being seen as perhaps a fringe to do with CRISPR. You've probably heard of CRISPR technology, which has to do with DNA slicing to a certain extent, but it's increasingly being used as a mainstream technology across the medical space. Other, just very quickly, if I can touch on it, um, everyone knows about social media and the disruption there, but I think many of us don't realize that online gaming today is 4 times the size of Hollywood. So here I am in Los Angeles. Hollywood gets a lot of hype, but
Mm,
actually it's shrinking in size relative to gaming.
mm,
So even though I'm a little older, I believe that online gaming is a very, very impressive industry. Sometimes parents badmouth it, but the truth is, um, I think it's great for kids to develop certain skills. The technology behind the graphics is often even superior to what you see in Hollywood. So we actually
mm.
see online gaming growing to be about 5 times the size of Hollywood. And we wouldn't be surprised if gaming and social media draw closer. So this Microsoft Activision deal is very prevalent amongst more and more people I speak to, that you'll see those types of tie-ups over time.
Yeah, fantastic. Well, a good insight to end on, I think, and that just leaves me to say thank you very much for joining us on the show, Anthony. It's been a real pleasure.
Pleasure. Thank you, Hayden.